Hi, welcome to the latest episode of the AJ Bell Money and Markets podcast. My name is Dan Coatsworth, and joining me is Danni Hewson. Hi there, Danni.
Hi, Dan. Hi, everyone watching, listening. It has been a huge week for markets, and Dan and I are going to at least try and unpack what it means for your money.
Now, disturbing scenes in the Middle East have caused oil and gas prices to soar, and financial markets have a bit of a wobble. So we're going to explain why these movements have happened and kind of what the implications are for shares, for bonds, interest rates, and lots more.
Chancellor Rachel Reeves was back in the news with her spring statement and a new economic forecast from the Office for Budget Responsibility. We'll explain the key points from that event and whether it changes the outlook for our personal finances.
Now, in amongst all these big events, there are a couple of interesting developments regarding quite well-known companies in the retail and leisure sector. So we'll be unpicking Greggs' latest results and explain why WH Smith's successor on the high street isn't doing that well.
There was also some bad news for anyone who invested money into pubs and brewery group BrewDog, and Dan's going to explain why crowdfunding is not the same as investing on the stock market.
Now, we were chatting about wills on the podcast the other day, and there's something important happening on this topic during March, which you might want to look out for. So we'll talk about that in a little bit.
We've also had a lot of questions about AI and about what it means for various sectors. With that in mind, we've got a couple of guests on the show this week to talk about different angles to the AI story.
And Danny's going to talk to Simon Skinner at Orbis about US sectors that have had an AI tailwind. And you're also going to hear my chat with Colby Stilson from Brown Advisory about why big tech firms have been tapping the bond market for large sums of money to fund their AI infrastructure work.
So we've got a whole lot of interesting stuff for you on the pod this week. And while we do have a broad range of topics, as we always like to, we have to start with the main talking point, which is what events in the Middle East mean for shares, bonds, funds, and more. And Dan, I'm going to pick up because obviously energy has been the sort of main focus of a lot of people. If you've seen any newspapers or news websites over the past couple of days, you will undoubtedly have seen stories about the rise in oil price, gas prices, and potentially what that means for all of us here in the UK. And I didn't want to talk about the oil price without going straight to my screen to have a look at exactly what is happening now, because it is volatile to say the very least. So just looking yesterday, as we record this on Wednesday the 4th, just before lunchtime, the price of a barrel of Brent crude is $82. Now, it tipped over $85 a barrel yesterday, which is the first time that that's happened since July 2024. Which, of course, then starts the drumbeat that we are likely to see a rise in the petrol price. And that is certainly something which is likely to happen. And that's important, of course, because the petrol price has been coming down. We had Brent crude hovering around $60 a barrel in December. So that just gives you an idea of how high it has gone because of the expectation that all those ships that are stuck in the Strait of Hormuz carrying oil and gas won't be able to get to their destination. We've also seen examples where some of those exports and production have been either stopped, blocked, or otherwise impacted, which is making a lot of worry about how much supply there is going to be. But I think for me, the gas price is the one that really sort of caught my attention yesterday. So it's at its highest level since 3 years. That was yesterday. It rose above 165 pence a therm. It is down now to just over 140 pence a therm, but we are still talking about the highest level since 3 years ago. And anyone listening to this, thinking back to 2022, will start to realize what this could potentially mean for inflation globally. And it is that which has really begun to rattle market. We now have the expectation that interest rate cuts Certainly, the Bank of England's one later this month had pretty much been nailed on by markets. They were expecting it was a done deal. Now, huge question marks about that, huge question marks about the path of interest rates for the Federal Reserve. And it's making a lot of investors, Dan, look at their portfolios, make adjustments in some cases. They are selling things that have done very well for them just in case they fall away. But we're seeing some big movements.
Yeah, I mean, I went back and to look at Monday, Tuesday, and we've seen a little bit as we're recording this on Wednesday about the sort of the patterns of what's been going on. The 3100 sort of fared better than quite a lot of other parts of the world on Monday because it's got really big exposure to oil companies, to gold mining companies, and obviously the oil price goes up, the gold price goes up. Naturally, these companies, the earnings prospects improve for them. So that's why the UK market didn't fall as much as others. Come Tuesday, as you said, Danny, people suddenly sort of reach for things that are already in their portfolio, that are already done well, and we saw things like defence contractors fall, which you might think is the opposite of what given this backdrop. People think, okay, well, if governments are worried about security, they want to spend more money on defense, for example, then surely the earnings prospects improve for defense companies. But no, we saw defense companies fall, we saw the gold price fall. And again, this is probably down to people saying, I'm a bit worried about what's going on. I'm just going to lock in some profits. Things I know have already done well, so I'll just take a bit of money off the table. Now, I guess some people would perhaps call that, is that capitulation? Everyone's panicking, everyone's worried about stuff. What's really important to me, having watched lots of ups and downs in the market, is come Wednesday we saw a much more stable environment here. You had sort of just small gains across the European markets, lots of sort of shares holding up firm, and I think you've got a mixture there. People buying stuff they think will continue to do well no matter what's going on in the world. So things like utility companies. We've also got people going back into defense companies again, but also there's mining companies are going up, and of course that's linked to views on what's happening with the global economy. So it's like shows a little bit of risk appetite. So I think as we're recording this, things have sort of started to calm down, and this plays back to what we always say when we get wobbles in the stock market. You should never really panic at the first sign of like alarming things you see on the news. You should just sit tight and just see what's going on. Just being really patient does pay off. And I think if you go back, we've looked at some other sort of difficult periods of markets before, and you can see what's going on. So I think everyone will listening to this now will remember Liberation Day last year. Donald Trump came along and said, going to impose all these big tariffs for various parts of the world for goods sold into the US. We saw the stock market drop by 11% from peak to trough off the back of this news. And this is I'm talking about this is the FTSE All World. This is a benchmark for the global stock market. It only took 30 days for the market to recover again, and now markets are 23% higher than the start of that sell-off. Go back to COVID. That was a 34% crash from peak to trough. It took a bit longer, 373 days to fully recover, but markets are now 144% higher than the start of that COVID sell-off back in 2020. So I'm not saying it will always recover, but it just shows the sort of the patience of it. I mean, Danny, what obviously you're looking at this, on an hourly basis. You're looking at what's going on in these markets. So, how do you feel at the moment? I know we're kind of only sort of 3 days into what it could still be a very difficult period of markets. Do you feel like people are now sort of perhaps taking a step back, taking a moment or a pause, take stock of events?
I think they are, definitely. I think also, that first initial reaction to what was going on and the rhetoric that was coming out of the White House, and of course, the huge number of attacks that were taking place, and of course, all the discussions that were going on with world leaders and whether or not certain countries like the UK were going to get involved or not. It was impossible not to ignore that for a lot of people waking up on Monday morning and going, okay, we're seeing some big changes here. I think what's happening now is that, first of all, people are looking at some of the market reactions and thinking, okay, well, yeah, the oil price has gone up, But when Russia invaded Ukraine, we were talking about $120 a barrel. And there were a lot of commentators at the weekend saying we could see it hit $100 a barrel really quickly. And that hasn't happened. Now, the question is this just a delayed reaction? Is there enough in terms of supply at the moment to be able to sort of cushion that? I suspect the answer at the moment is yes. And I think investors are thinking, is this going to be a long conflict, or is this going to be something which ends quite quickly? And clearly, for things like inflation and the impact that that could have on all of our lives, we all remember the cost of living crisis when energy prices went sky high, when the cost of food went sky high. People are now looking and thinking, what does this mean for basics like fertilizer? This is a massively important commodity. When you start thinking about, the stuff that needs to go in the ground that's going to end up on our plates next year, but also the impact it's having on current shipping. We've seen big snarl-ups, as I say, in the Straits of Hormuz. The price of those super tankers has gone up to record levels in the Middle East. So that is obviously for transporting energy. But a lot of companies are also thinking about insurance. The price of that has gone up. But this is something which a lot of companies now have built into their business policies. They've been through this before. They understand what to do when this happens. And I think we're at the moment where we're just not quite sure how long this conflict is going to last. If we're talking a matter of a week, a couple of weeks, then we don't really need to start thinking about stagflation, that inflationary spike returning and all that means. If it goes on for longer, then I think we do need to start considering that and really sort of building that into our portfolios. But you're right, at the moment, because there is so much uncertainty, I think people are taking a breath. They're remembering that with Donald Trump, quite a lot of the time we see one big step forward and then a couple of shuffles back, and they're just building that in.
I think there's potentially two issues to consider here. I mean, one is obviously the act of war, and that always would put markets on edge. The other thing is, obviously you mentioned about inflation and sort of changing the path of interest rates, and so that feeds into sort of valuations for financial assets. But I think we also need to think that stock markets were doing incredibly well up until last week. Even though we've had nervousness around AI spending, AI disruption, I think there was still sort of investors found enough places in the world to give them the confidence to keep going. And so, we've had some quite testing periods in the last few months, and yet markets are they've wobbled and they've pushed on. We just don't know whether that trend will continue. It is worth pointing out that there's other things going on as well, which are still troubling markets, but things like concerns around private credit. We've talked about this last year on the pod. There's a collapse of a couple auto companies, First Brands and Tricolor. And then more recently, in the last few weeks, we've had some big sell-offs with private credit funds. There's sort of concerns around the values of the loans that they hold. All these things are sort of bubbling away in the background. But for every time we've got, companies issuing bad news, we do have lots of companies issuing good news. And so I think as an investor, it's easy to be, go, oh my God, my head is swirling around. There's so much noise going on. But it is very important to try and keep a clear head and just try and stay focused. And if you've been putting money into an ISA or a pension every month, you're just feeding your account and looking at the long term, you sort of have to say, well, I should consider doing this during bad times as well as good times, because if I'm investing when the markets are down, I'm actually being able, this set amount of money I'm putting into my pension or my ISA can actually buy more stuff with my money than it had done when markets were higher. But it's just this sort of regular habit. I know it's quite hard to do this when you're reading all this bad news, particularly day after day. You think you've lots to worry about, but keep time in the markets is so much more important than trying to time these markets. And if you can hold your nerve, history suggests it might work in your favor. No guarantees, but it just might.
It's interesting what you said about filtering out the noise, because we're going to hear from Simon Skinner from Orbis later on, and he talks about that, how you really sometimes just have to focus on the fundamentals, what you know about a company, why you're looking at investing in this company, rather than listening to the huge clanging sounds of sirens of doom which are going on all around you. So yeah, do keep listening for that one. But talking about noise, normally when we have a big, in inverted commas, fiscal event in the UK, there's an awful lot of noise which is made about it. But you might not even have noticed that the Chancellor gave her spring statement yesterday, considering everything else that is going on in the world. But we did have the speech on Tuesday. It's fair to say, Dan, that there was a mix of good and bad news. So what does it mean for our money?
Well, yeah, you're right. I mean, I looked on a couple of news websites, and you normally expect that to be the lead story, but it's buried way down. And so what we had was, we had Rachel Reeves come out very, very confident tone, sort of kind of implying everything was going well. Her plan was to get the public finances in order, create this clearer path for economic growth, and she gave some very good reasons why that's all now under control. But always, it's this waiting game. And I think that what you need to do is look at the OBR forecasts. And it came out and said, we now think that the UK economy won't grow as much as we previously thought for 2026. But we think from 2027 onwards, it'll actually do a bit better. And we also had unemployment expected to rise this year, but also potentially peak. So essentially, the key things that the takeaways from this is that Rachel Reeves gave this very confident sort of tone, and it's saying that her plan is working, but this year isn't necessarily going to be as good for the economy, for the jobs market, as we thought a day, 2 days ago. So I think obviously, and then we've got the factor is that the inflation and global trade policies, they're the elephants in the room. So the OBR flagged both of those as key risks to its forecast. So it's a tricky position. So Rachel Reeves is saying, as it stands, things are going to plan. However, that doesn't factor in. We just had 2 days of very, very sharp rises in energy prices, and the tariffs and the trade issues with the linked to the Trump administration is they're still a moving feast. So it's really hard to sort of say, okay, everything is now fixed in the UK. We're all fine. We still got some unknowns to consider. And I think that's why people sort of took a step back and say, well, spring statement, there wasn't masses of bad news in it, but equally there wasn't masses of really good news in it at the moment. It's like kind of like a steady as she goes, but still not quite sure what's going to be around the corner.
Yeah, it's fascinating. I mean, the fact that she's got a bit more headroom than she'd said previously is good news. But of course, then you have, as you say, the elephant in the room. The ink had not been dry on the OBR's forecast before, we got this changing situation. And if she does need to give more assistance to businesses and to households in terms of energy bills, then that headroom is going to disappear incredibly quickly. So you're right. It is a moving picture indeed. So, yeah, I imagine that all eyes will be now on the speculation as we head towards the budget, and that's probably going to start quite quickly.
Yeah, yeah. Right. Let's move on to some company news. We had results from Greg's. We like to talk about Greg's a lot on the podcast. Lots of people love to hear about it. That's interesting. It's weird because it's the markets were all falling. Greg's share price rising, but it actually reported quite a big decline in profit. So, Danny, what was there something in there that basically Greg's saying we're going to give out a load of free sausage rolls or something? Why is everyone suddenly happy about this company when they've been quite miserable on it for a while?
It was interesting, yeah, because I mean, as you say, I mean, the drop in pre-tax profits was almost 18% for the year to the 27th of December compared to a year earlier. I mean, that is a big drop in profits. I think it was the fact that Chief Executive Rasheen Curry was really bullish in her tone. She said, I absolutely don't believe that we have reached peak Greggs. And this is a question which has been really sort of circulating about a lot over the past year. We obviously saw huge pressures in terms of consumer spending and on prices for the business itself. And what Rasheen Curry was saying is that a lot of that is now beginning to balance out, and that they are now expecting that they're going to be able to continue to expand the number of shops that they are going to open. So it opened 121 in 2025. And it is targeting another 120 openings this year as well. So, it says that sales growth have been supported by more deliveries and also some of the change in things like shops staying open longer into the evenings. So I think for investors, they have really built the foundation to be able to continue growing. They are demonstrating an awful lot of resilience. And I think that was what a lot of investors were really grabbing hold of in terms of why shares went up, despite what was a pretty gloomy set of figures. Um, and there's also been worried about, obviously, weight loss jabs. And she was talking a lot about that last time. But this time it felt like they've been factoring into a lot of consumer changes and challenges into their whole business model. They are changing some of the offer that they have in order to make sure that there is something for everyone, whether or not you're wanting high protein. You don't just want your steak bake or your pizza. You actually want to have something which is more balanced. And they are opening in parts of the country where they are seeing opportunity. And I think for a lot of people, they just like the Greggs business model. And it's relatively low cost to open one of these. And in terms of travel locations, there is still an awful lot of opportunity for Greggs to, really sort of take more of a chunk of the market. So for investors, I think they sort of looked at these figures and thought, yeah, it's not great, but we haven't reached peak Greggs. There's still a bit more room for growth. And maybe that's why we had a bit of cheeriness going on.
Yeah, I mean, I was very surprised. I mean, it was they always talk an optimistic outlook, and I guess they would always say that there's room for more. But I just anecdotally, I walk past Greg's stores, and yes, there's a queue there, but I also see lots of people give up because they can't be bothered to wait. I just think, and we talked about it before. It feels like they've got quite small stalls sometimes, and it's like people. They want to be served quickly. Yeah, it's the food on the go. You want to eat it, grab it quickly. That includes being served quickly, and I don't think they're quite sort of come across the right sort of formula for how to do that yet. I guess we'll see.
It'll be interesting to see how they implement AI and things like, the opportunity to pre-order in apps and that kind of stuff. I mean, there does, as you say, need to be a bit of a shift there in terms of people being able to grab their food on the go as quickly as possible. That said, it is one of the few places I know that I'm happy to wait for a certain amount of time because I just want to get that bacon butty and that cup of tea. So, yeah. But when we're talking about the high street, let's talk about another big brand, WH Smith. It absolutely massive, part of most of our lives, in terms of, going and buying school books and pens and that kind of stuff. The company that took over those high street stores isn't having the best time. I don't think really many people are going to be surprised about that, Dan.
Yeah, so Medela bought 480 of W. Smith's UK stores last year, or the UK High Street, rebranded them as TG Jones, which is, I don't know, it's like a bonkers name. what? And now it's sort of saying that there's talk there's 80 of these stores could be shut because they're not trading very well. I mean, Danny, have you been to one of these newly branded TG Jones stores?
No, I haven't. But then I don't do an awful lot on the high street. And the only time I tend to go into one of these stores is when I'm traveling. And therefore, it is still a WH Smith store. And that is why, of course, WH Smith kept hold of that bit of the business, because that bit of the business makes sense. And in terms of trying to turn around the high street business, they've not made many changes.
No, I mean, so the one near where I live, it feels like it's like they've got someone on work experience and said, like, just type in TG Jones into a computer. We'll just print it off, whatever the first font you pick. And they've stuck a very, sort of amateurish sign outside the store, gone in, changed the till roll so it says TG Jones, and literally that's it. And it's like, these stores were always W. Smith has had a reputation for having fairly sort of messy stores. It didn't want to invest. I mean, that's how it made so much money from them, because it just it worked them until they were unworkable, and it had no choice but to sort of spruce them up a bit. And I think that Modelo is basically banking on people thinking, well, I always remember that W. Smith is midway on the high street, and I know I'm going to go in there. And it's basically people wanting people to not actually notice that they've got a new sign outside. I'm wondering whether people are now going, oh, hang on a minute, it slightly does have a different name. And, actually these prices are quite high. Like, it's convenient. You've got lots of things I might need, but, do I really want to go here? There's no trust for this brand anymore. And so, yeah, I think Modelo are probably realizing that it's a little bit harder to make these stores still relevant now without they're gonna have to need to spend some money or make some big decisions and slim this store down, the estate down quite a lot.
Yeah, I mean, the locations of some of these stores are great if you've got a thriving high street, but certainly the WH Smith store here where I am, it disappeared and it's never returned because there just wasn't the demand. So yeah, I think they're going to have to really think about what it is they're offering the consumer, because unfortunately, it's just too easy to get stuff online and get it delivered the same day. Or you can have the convenience of things like supermarkets, which provide an awful lot of the same stuff. So they're going to have a fight. But I think there is an opportunity there. But you're right, they are going to have to stick some cash in. Yeah, let's see.
And so, another name that perhaps people are quite familiar with is actually going through changes as well is BrewDog. So this is you might have bought some of its beer in the supermarket, or you might have been to one of its pubs, but it's just had a takeover. But this is like quite an interesting situation, and there's a reason why I want to talk about it. But Danny, just give us a quick 30 seconds about what's happened. Why has this takeover happened?
It's happened because a lot of the hospitality sector has really been struggling. BrewDog obviously made a name as being kind of an out there brand. It was a bit new, it was a bit feisty and funky, and real ale was pretty massive at one point. But the demand has been falling a little bit. Certainly the number of different options you've got in supermarkets, I'm not seeing quite so many as I used to do. But as you say, this craft beer brand has been struggling for a while. It went into administration at the start of the week. It was bought out of administration by a US brewer and cannabis group, which is interesting one. That's Tilray. Now, not all the bars are going to be saved. So 11 of its pub venues across the UK and Ireland will stay open. 38, not included in the deal, will close. And unfortunately, that means 484 jobs. But it was the nature of the deal, the fact that the company went into administration and then was bought out of administration, which then left quite a lot of small investors in particular out of pocket, Dan.
Yeah, so BrewDog's not on the stock market, but there was an opportunity to have invested in it privately. So go back a few years, it used a crowdfunding platform, and it had this scheme called Equity for Punks. And basically, it sort of said, you know, help. Would the public? Would you like to buy small amount of money? Sort of you could put a couple £100 in potentially, and you could get shares in the business, and you get perks like money off its beer. And I think for a while, BrewDog was people liked it. They thought it was going places, and so there was a lot of people bought, put small amounts of money into it, and sort of thought, okay, maybe at some point, if this floats on the stock market, I might have made some money by then. I might be able to easily sell out if I wanted to at that point. What actually has happened now is that whilst the company's been taken over, there's anyone who'd bought shares in this crowdfunding scheme, they've lost everything. And I think that lots of people didn't realize the risks associated here. And one of the key things with crowdfunding is it's quite hard to be able to sell your shares in a company when you want. And in the case of BrewDog, it held trading days where investors could sell their shares to other people. But the last time this actually happened was the 31st of August, 2022. So it means that in the last couple of years, where there was sort of some signs of things weren't going as well for BrewDog, these investors couldn't sell unless they found someone privately who would want to buy them. So this is really difficult. Now, if this company was on the stock market, you might have expected someone in its situation, you might come out saying that things aren't going as well, and the share price might have fallen, but people could potentially have taken some small losses on it and decided to sell out by selling on the market. But because it's crowdfunding, it's not that simple to do. In the case of BrewDog, I just think it's people talk getting into investing, finding it a bit more interesting. There's a real distinction between investing on the stock market versus the crowdfunding. I just want to sort of make that sort of a point. And if anyone's got any questions about it or other examples, they want to know more about the difference between the two, just drop us a line, and we're happy to talk about more in detail. It's podcast@ajbell.co.uk.
So before we bring on our first guest, Dan, you mentioned wills at the start. What's changing?
So go back, I think it was a couple of months ago. We were talking about wills on the podcast, just in general, the importance of getting one sorted. And at the time I mentioned that I think it was every November they do this national scheme whereby if you make a charitable donation, you can actually get a will for just for that donation. You don't actually have to pay the normal amount of money that you normally do. What it's just turned out, it caught my eye the other day that there's something called Free Wills Month, and it runs in March as well. So a group of charities offer people that are age 55 and over to have a simple will written or updated free of charge by various solicitors. So if you go into, I thought I'd just reference this because I didn't realize this scheme existed in another month beyond November. So just type in Free Wills Month, and there's a website. It talks about all the different things that are going on. I won't go into ins and outs of why you should get a will. I think it's just really important to be able to you should look at this seriously if you've not done one before, and this is an opportunity for you to potentially get one for a lot less money than you perhaps would normally pay for one.
That's really interesting that you bring that up, because we have a companion podcast called the AJ Bell Money Matters podcast, which is primarily aimed at women. But our next podcast episode is going to be featuring wills. We're going to be talking all about wills, why you need to make one, what you need to do. We've got an expert on to talk about it. So do take a look at that.
Oh, fantastic. I didn't know about that. I would definitely be tuning into that one. So thank you for flagging that one, Danny. Right. Okay. Let's special guest time. Actually, we've got a double header this episode. So whilst all the stuff that's going on about Middle East is sort of grabbing people's attention, for months or even a couple of years now, AI has been such a big talking point. So we thought it was worth getting on a couple of experts who are offering a little bit of a different take on events. So later in this podcast, we're going to hear about why big tech companies are turning to the bond market for their AI investments. But let's first bring on Simon Skinner, who leads Orbis's global investment team. So Danny recently caught up with Simon to discuss US sectors that have got potential AI tailwind. But lots of you listen to this podcast on places like Spotify, Podbean, and you'll notice no difference this week. But for those who actually watch the video on YouTube, I must apologize. We had a bit of a tech issue, and gremlins have sort of caused a slight problem. We can only hear Simon's interview. We can't see him, but it's a brilliant chat. So we still wanted to include it. So let's hear what Danni and Simon were talking about now.
Simon, thank you so much for joining us. Look, all anybody seems to want to talk about at the moment is AI. It does feel like the AI excitement of the past couple of years is becoming AI fatigue. And even when you get some pretty impressive results from the likes of NVIDIA, investors don't like it. Is it just about the amount of cash being spent, or is there something more fundamental here?
So it's an interesting question, but I also think it's an impossible one to answer. What we know is that, as you say, AI has been the hottest topic in investment markets for several years, and no one in the world doesn't know that this is happening. And you have a couple of flagship, very large companies that have done extraordinarily well based on this AI narrative. And I like to, in moments like this, step back and try and be a student of history. And so, when we have a big technological shift and you have a few companies which are apparently at the forefront of that shift, people tend to get very excited and they extrapolate incredible performance for an awful long time. And they use that narrative to justify extraordinary valuations. And so if we look at the absolute size that these companies have got to in terms of their market capitalization, it's far larger than anything you might have expected several years ago or that we've seen in history. And so embedded within those huge valuations are incredibly optimistic expectations. And anything which chips away at a perfect future for these companies is probably not going to be good for the share prices. And so it could be that the companies are going to end up being more capital intensive than people expect. It could be that there might be slightly more competition than people expect. Or it might be that people just think the end state is slightly less certain or less clear than they had a couple of months ago. But any of those concerns becoming apparent to a small pocket of investors will cause the share price to be less than good, which will start to change the narrative. And, exactly as you're asking, NVIDIA posted fantastic results recently, but the shares are now down after that. And so people start to second guess and they build another narrative, which is, well, these were the first companies of AI, but maybe they're not the most, they don't attract all the economics in this dynamic. And so maybe I should be shifting my capital somewhere else, or I should be more conservative in my valuation. And so it's often that we don't know what first starts to change that wave of sentiment. But, if you look back at history, it's very unusual that investors have been able to accurately assess all the winners of big technological shifts. And I think that's what we're seeing today.
It's been really interesting to talk to people, to talk to investors over the last really 6 months, because there was sort of a shift from investors looking at the big AI players that we know and love, like NVIDIA, and trying to figure out which sectors might benefit from AI. And then, of course, into the mix, we have the likes of Anthropic's Claude and those plug-in tools, which have really upset some parts of the market. And I'm thinking of the likes of finance and the legal profession and software. Are investors right with some of the moves that they're making, or do you think that there's a lot of overselling going on?
So I think it's hard to say whether investors are right, because it's just uncertain. But I think what has been correct is that people are putting a more cautious view of the range of outcomes for some of those businesses than they have in the past. And so previously, some of these data businesses or the software businesses would have been regarded as very high quality businesses with enduring business models, great pricing power, very strong economics for an awful long time. And even as you start to question whether you can be certain of that look far into the future, you probably demand a slightly higher return from those stocks in the near term, which means their valuations compress. Now, that doesn't necessarily mean the stocks are oversold, though, because if the future does turn out to be a lot worse, well, these businesses started at quite full valuations because the market was convinced they were the highest quality companies around. They also started with very high levels of profitability. So some of the businesses you've described have some of the highest margins we can see across the stock market. And so if you see a scenario come to pass where, say, competition increases because of AI, for example, and pricing power declines, and maybe their margins decline, and that happens at the same time as sentiment turns on those stocks, actually the valuations could compress a lot. And so I would be very cautious to say that as a basket, those types of companies are oversold here. Certainly they're less highly valued than they were, but we've seen if you can get on the wrong side of these big technological shifts, you can see an awful lot of value lost from market share prices before you get to something which you can say is oversold. And so, you might think about what happened to newspapers with the advent of the internet. And the first time that, the Yahoo came out with its news page or the classifieds website started popping up, I imagine those newspaper stocks started selling off, and we could have had a conversation about whether they're oversold. And 15 years later, most of them were bankrupt. And so when you have these big shifts and you're not sure that you're going to be on the wrong or the right side of it, I'd be quite cautious in saying in the first 6 months, you have a clear view that those businesses are overly discounted.
It's an absolutely fascinating period of time. And the one thing that we're also seeing is interest in maybe some sectors that can sometimes be overlooked and the potential that they are going to benefit from AI. And healthcare is most certainly one of those. How do you view those opportunities? And are there other sectors where you're looking and thinking, that's interesting?
So I think you raise a good point about the kind of the approach that one might bring to investing in this period. And we think about the market as being a very rich opportunity set, thousands of companies globally that you can choose to invest in at any one point. It's very often the fact that the best value is found away from hot topics or key debates for investors. We like to go to places where no one's thinking about, no one's really analyzing, particularly retail investors have showing no interest. Sometimes boring companies that do something which we think is essential, but perhaps undervalued because it's not exciting. There's no interesting story to write about it. So you're absolutely right that healthcare has provided some opportunities for us. So in some areas like laboratory services or sterilization, these are essential services that are providing services into a sector which has proven itself to be quite stable over time. So the US healthcare system, so companies like Bruker in equipment or Steris in services. The other area or the other type of stock that we're finding interest in at the moment would be businesses which we think AI can offer the opportunity to execute ahead of their peers. And so what we're seeing at the moment at the front end of AI is a huge amount of investment into tools and capabilities, the likes of which we haven't seen before. That doesn't mean that those tools will be used equally well across all businesses in the market opportunity set. And we have high conviction that businesses run by proven entrepreneurs who retain a large stake in their businesses are likely to benefit ahead of their competitors. And the market probably underestimates the upside in those situations. And we find those entrepreneurs are often more decisive, they have more clarity, and they're more willing to do unpopular things in the short term, which position their businesses well for the long term, such as replacing software with AI or forcing their staff to adopt these new tools much more quickly than you might find in a more conventional business. So some examples would be across a range of industries. So we have Interactive Brokers, which is an online brokerage service. We have QXO, which is Brad Jacobs' new building products distribution business. And we have Ron Clark at Corpay, which is a payments business. Now, they're very different on the face of it, but the common theme is that they have a strong leader who we believe can execute well with these new sets of tools that are becoming available.
We've spoken a lot about potential risks, but I'm interested in how you drown out the noise, because a lot of time, investors might feel they might have a conviction about a company that they bought stocks in, but the noise they just can't ignore it. So how do you deal with that?
So this is the classic emotional struggle that we have with herding in markets, and the pressure to conform and do what the consensus believes can get intense. And if you haven't owned large US technology stocks for the last 5 or 7 years, the pressure has been incredible because those stocks have done so well. They've driven almost all the market returns, and they're in the media and the news every day. And so, you have a constant reminder that you're wrong and you are giving up value by not owning those stocks. And so it does create a lot of pressure. the best way we found to deal with that is one, just to be aware. So to be aware that the moments in history which are most dangerous to capitulate and give in to that pressure have turned out to be most dangerous from a future returns point of view. So if you were invested in technology stocks in the year 2000, or if you were invested in US housing stocks in 2007, those have been, the key points in history where actually you've seen, it's been a poor decision to be invested with the herd at that point when the pressure feels most intense. And we've built our whole firm around resisting that pressure. So we have no external shareholders. We put no premium on short-term performance. Indeed, we accept that short-term volatility is the price you pay for long-term outperformance. And we are very aware that the pendulum in the market can swing hard and fast. And so when you sense that everybody believes in one very narrow outcome and are positioned for only one kind of future version of the world to unfold, just to be cautious and to really understand that if that future doesn't unfold, the consequences will be quite dramatic. And, not being involved in that area can turn out to be an excellent decision over the long term.
Considering the volatility in the world at the moment, dealing with those pendulum swings is something that we're all having to get used to. I mean, when I first arranged to talk to you, I wanted to talk to you about tariffs because that was something that we were all getting caught up in again because of the changes from Donald Trump's administration. Of course, as we're recording this, people aren't talking about tariffs. They're talking about what's going on in the Middle East. But maybe next week they'll be talking about something else. But we do still need to address the tariff issues. So has the recent upheaval and what looks set to be quite a difficult period of time, has that impacted your investment decisions at all?
So the short answer is yes. But not for a specific reason around a certain tariff outcome. So, we fully acknowledge that the world is an uncertain place. And actually, I think it usually feels more uncertain today versus history than it would have done if you'd sat in the same shoes 30 years ago. So, we could have been in the Cold War, or we could have had the global financial crisis, or we were in the middle of COVID. Like there was usually something big and scary going on in the world that you can become concerned about. And so rather than try and make specific bets on a certain outcome or say, I think this tariff is going to be implemented and this one is not, we find it more conducive to better investing to try and be in situations where you don't have to make those calls. So we like to find businesses which we think are undervalued under a range of circumstances. And we try to be have a high degree of humility about being able to predict those big macro, sometimes political calls, but find businesses that can thrive whatever the weather brings. And now there aren't many of those around the world, which is why we go, very carefully stock by stock, bottom up. And it's why our portfolios look very different to the broader stock market indices, because we are being specifically choosy about the situations where we are choosing to invest. And we are avoiding those situations where the whim of a politician or a tweet or some geopolitical outcome can make or break your investment case.
So thanks again for Simon Skinner from Orbis for coming on the podcast.
Let's bring on now our second AI-related guest. Colby Stilson is one of the bond experts at US asset manager Brown Advisory, and Dan recently caught up with Colby to talk about the likes of Meta and Google coming to the bond market to raise big money. Let's hear that now.
Well, I'm very pleased to be joined by Colby Stilson, who is co-portfolio manager of Brown Advisory's Global Sustainable Total Return Bond Fund. So, Colby, thank you ever so much for coming on the podcast. I hope you're well.
Very well. Thank you very much for having me.
Well, I want to talk to you about the world of big tech companies raising money to fund AI infrastructure investments. And they're doing so by issuing corporate bonds. Now, to me, this is slightly unusual because the type of companies that we're talking about, they generate massive amounts of cash flow. And I always get the impression they could probably just fund all this stuff out of their own money that they've already got. They don't need to turn to the bond market. But I just wondered, before we start to talk about why this is happening, could you just give our sort of listeners a 10-second explanation of what on earth is a corporate bond and how does it work?
Yeah, for sure. It's actually relevant to the first part of your question, which is why issue bonds. So a company, a publicly traded company, in the example of what we invest in, has generally two options to raise capital. They can issue stock, or they can issue bonds. They're essentially raising capital from an investor by raising a bond. That bond has a certain term associated with it, where the capital that is raised is due back to the investor. And over the period of that term, they're responsible for interest payments to the investor.
Okay, so obviously, yeah, you as an investor, you collect a regular income, and at the end of that period, you hopefully get the face value of that bond back, don't you? That's how it typically works. So, I guess
Yes, relative to equity, it's a fairly asymmetric asset class, or it's an asymmetric investment profile, which is important to this conversation, which I'm sure we'll get into. There's very little upside as a bond investor, and downside is essentially default and maybe even zero. So bond investors think about these investments very different than equity.
Yeah. Okay. So we're talking sort of big tech companies raising money through the bond market. So I guess what names have been doing this recently, and why is this quite interesting? Because perhaps we'll go back to my first introduction. Like, why are they doing it through the bond market and not just using existing cash flows?
Yeah, I think it's interesting to make a distinction between two different kinds of behemoth tech companies. You've got the tech companies like Google, Amazon, Microsoft, Meta, that have wildly large free cash flow generative businesses that are now raising bonds to fund these AI investments. And then you also have large tech companies like an Oracle that has a little bit higher risk profile associated with it, given the fact that they don't generate as much free cash flow. So I think those are the types of companies that we're seeing in the bond market, and in uniquely larger volumes than we have historically.
Okay, so I mean, so the money that they're raising, then we talk about AI infrastructure. What is it that they're doing? This is money to build a data center, to pay for microchips and stuff like that, is it?
That's right. Yeah, building the infrastructure, which would be things like data centers. In some cases, even power infrastructure, to the extent that there are bottlenecks on things like the electricity grid. And then also all of the equipment within the data center that supports all of the AI compute. So think GPUs or general processing units from the likes of NVIDIA. And those can be upwards of 30, 40, 50% of the overall cost to build this AI infrastructure.
And so why are they going to bond markets then? Is this, to me, it's sort of, I was reading about it, and lots of people sort of suggesting this is like slightly unusual. But you as a bond investor, do you think actually there's no reason to think this is unusual? It's normal practice.
Yeah, you mentioned it earlier. Historically, this AI investment, I would say boom, it's been significant, but this AI investment cycle has been funded by free cash flow. And so it's largely been, the risk associated with that investment has largely been contained within each of the businesses that are funding these investments. As these investments scale, so for example, the four companies that we mentioned earlier, Google, Amazon, Microsoft, Meta, between them, they're projected to be spending upwards of $650 billion US in this year on AI investment. Now, these are wildly profitable businesses, but there is a limit to the free cash flow that they generate. So when we're talking about scale like this to invest in AI, they're going to have to diversify their funding base. And so coming to the bond market to support that is part of the capital strategy for them.
So obviously within that sort of area, I noticed that Google's parent company, Alphabet, had raised 100-year bond. So it's basically saying it's going to pay interest out for the next 100 years before essentially redeeming that bond. What, when I read about long-term bonds, people sort of say 30 years is long-term, but 100 years is bizarre, because your average investor buying that now, they'll be dead before that bond matures. Why is such a long period?
Well, I think mostly because they can. There is appetite in the fixed income market for very long duration bonds, bonds with long maturities, particularly within the insurance and pension and sort of endowment space. The sterling market, that was a sterling issuance in the UK market. This market in particular has demand for that sort of maturity bond. And so I think because there's that demand, Google has an opportunity to raise money with those terms in mind. And for them, the opportunity set or the benefit to them or the advantage to them is that they get to diversify their funding base across more than just the US investor platform, so they can access new markets.
And so, what's the sort of response been like to these bonds that are being issued? I presume that they've got, these big companies have raised everything that they want. That there's still lots of people queuing up saying, yes, they're spending loads of money, but actually, these are big, solid businesses. They should be able to pay it back.
Yeah, I think. Well, I guess the first thing I would say is it's already difficult enough to forecast out 5 years with regard to where a business is going to be, but to think about it in the context of 100 years, it's virtually impossible, right? Especially in the technology ecosystem, where even today, more and more so than ever, the fluidity and how dynamic things can be, it makes that sort of idea of investing very difficult. But if you're an insurance company or an endowment company or a pension company, and you're matching your asset and liability, where you have liabilities way far out into the future, and you can match assets that provide you income against that, then maybe those are risks you're willing to take in very high quality companies. I think the companies themselves, they have been raising very large amounts of capital for more recently, and we expect this trend to continue into this year and beyond. I think there are projections out there that suggest trillions of dollars worth of spending needs over the next 5-7 years, and increasingly that's going to be coming by virtue of investor issuing bonds. And so more recently, the receptivity and the appetite for this from an investor standpoint has been very, very strong. All of these issuances have come oversubscribed. And what I mean by that is, if Google is coming to raise 20 billion of bonds, there's, 40, 50, 60 billion of demand. And so at the outset, when these bonds are raised and then put into the market for trading, there's very strong demand and they trade very well. But interestingly, over time, and when I say over time, even over the course of weeks and months, those bonds have kind of come off and have not been trading as strongly as they did right out of the issuance.
Is that because people are sort of worried, saying, yes, actually, we'll think they pay the money back, but actually it's what they're spending it on? Because even the idea of investing in computer chips now and data centers, there's potential that the infrastructure, the technology behind them could actually go out of date even this year, let alone in 5-10 years' time.
Absolutely. So beyond just the pressure that the fixed income market has by virtue of issuance and flooding of issuance, which there's a finite amount of demand. At some point, you're going to reach the end of that demand, and that puts pressure on the risk premiums that are being allocated to bonds accordingly. But yes, what you're referencing is what we call duration mismatch. So if I am issuing a bond that has a 10-year life, and I'm buying assets that have a 3, 4, 5-year life with that capital, by definition, the time mismatch there provides risk to the investor. And so it's, from our perspective, the increasing risk is definitely something we should be thinking about, and especially in the context of where overall valuation is within fixed income markets.
And so, have you in your fund, have you participated in any of these sort of bond issuance that we've seen recently?
We haven't. So in our fund, the way that we're thinking about credit valuation at the moment is that we are at generationally rich levels. And so when we're in an environment like that, from our perspective, we have to be very careful about how we invest our clients' capital. And the way that we're sort of thinking about this AI investment landscape is that we're kind of in a wait and see mode. We think that there is a lot more issuance to come. We think that business models are actually changing based on the fact that these businesses have what they used to be sort of capital light, recurring revenue model type businesses, which made them so appealing to begin with. And as we transitioned into issuing bonds and spending the levels of capital expenditure that they're spending, our view is that those business models are changing a little bit. And so we're in a wait and see mode we actually think that the credit valuation will continue to adjust as these companies become more capital intensive. And we think there will be a time to invest. We just don't think it's now.
That was Colby Stilson from Brown Advisory, and that is all we have time for this week. Don't miss next week's show, which is all about ISAs. If you have any ISA-related question, send it to us now. The email is podcast@ajbell.co.uk. We will try our best to get through as many of those as possible on next week's episode. Until then, thanks so much for tuning in. Have a lovely week.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.